Hi, I'm Dr. John McCallig. I'm an assistant professor of accountancy at University College Dublin. I published a book on introductory financial accounting using IFRS that you can download at the link below. This playlist of videos explains all the important concepts and techniques that are in the book and that you will need to prepare basic financial statements. I've included a link to the playlist of videos below as well. Please remember to like the video and subscribe to the channel if you found this content helpful. This video is going to be about the income statement. The income statement is different to the statement of financial position, but it is related to the statement of financial position. The income statement explains the changes in equity between two statements of financial position. Okay, so you've got statement of financial position at the start of the year, statement of financial position at the end of the year. The assets minus liabilities are going to change between those two dates, and the equity is going to change. The income statement is the bit that explains that change between two dates. The income statement is different to the statement of financial position in that it is prepared for the period from X to Y. So it's prepared for the period from the 1st of January to the 31st of December, or the 1st of April to the 31st of March, or whatever, but it is over a period of time. It is not like the statement of financial position that is at a period of time, and that is a very important concept. Under older accounting rules, the income statement was called the profit and loss account, and you will still hear people refer to it as the profit and loss account. So what items are on the profit and loss account? Well, the two major items are income and expenses. So income items are increases in net assets or inflows to the business. So things like sales revenues, fees, interest earned, or any other inflows to the business. Decrease in net assets, expenses are decreases in net assets or outflows from the business. Things like wages, purchases, telephone expenses, interest expenses, any kind of expenses you can think of that are outflows from the business, those are going to go on the income statement as expenses. It's very important to appreciate that the income statement is essentially driven by this idea, the accruals, or some people call it the matching basis of accounting. So accrual accounting depicts the effects of transactions and other events and circumstances on a reporting entity's economic resources and claims in the periods in which those effects occur, even if the resulting cash receipts and payments occur in a different period. So what does this mean? Well, this means that as accountants, we don't have to wait for the business to receive money in from its customers or pay money out to its suppliers to record these transactions. We can record these transactions when they happen, not necessarily when they're paid for or the cash is received from them. And this is a very important concept, and it'll permeate the whole course. But for now, what we've got to appreciate is when we look at the income statement, it's not cash that's on the income statement. It's something different. It's measured in a different way. It's essentially all the transactions that occurred in a certain period are in that income statement, even if they were not paid in cash or received in cash. Just a note about a special item on the income statement before we look at it, the cost of goods sold. This is the cost of buying in or making the goods that have been sold in this accounting period. And And the gross profit is sales less cost of goods sold, and the operating profit is the profit after all operating expenses. And profit for the financial year, or some people call it net profit, is the profit after all expenses, including interest and tax. So let's look at CRH's income statement then. You start at the top of, sorry, I just need to get my pointer. You start at the top of the statement with the revenue. This is an inflow. This is the sales revenue, the sales to customers. And for CRH, that was $27.5 billion. And then we move on to the cost of sales. This is the expenses that are associated with either buying in or making the products that we sold. So for CRH, this will involve the costs of all the factories, the labor, and everything else that went into making the products that were actually sold. Those two things subtracted give us gross profit, which is $9.1 billion for CRH. This is the amount of profit we've made after paying for making the products. But it doesn't pay for, there's no other expenses in there. We then subtract operating costs. Those are all the other costs of the business, and they, for CRH, amount to $6.8 billion, giving us a group operating profit of $2.2 billion. And you can see that's down a bit from the previous year. That's probably because 2020 was a COVID year. So CRH were probably not able to manufacture and sell as many products as they normally would be. So operating profit, what does this mean? Operating profit is the profit after taking off all the costs of making the products and all the other operating costs. Operating costs are all the normal costs like wages, administration, salaries of office workers, all the office expenses, everything that's needed to operate the company. And there are two other categories of costs that are important. Those are finance costs, down here, 389 million, and income tax here, which is almost 500 million. So we subtract those two to get our group profit for the financial year. And this is what some people call net profit, or the bottom line. And for CRH, that is 1.1 billion. That is the profit after taking off all of the expenses, the cost of goods sold, the operating expenses, the finance charges, which is essentially interest, and the taxation charges. Okay, so that is the standard way of organizing an income statement, and these are generally the items you will see in the income statement. Remember that these items, the amounts of these items, are prepared, are based on the accruals concept. So what you're seeing here is the amount of revenue for the year, which is the amount of sales transactions that occurred between CRH and its customers. Not all of those sales transactions were paid for. And if you think back to the statement of financial position, in the statement of financial position we had an account called receivables, and in there are all the customers that are included in sales here but haven't paid for their goods or services yet. Okay, thank you very much for listening. That was a key point video on the income statement. Remember to like and subscribe if you found this content helpful. Bye.